ultimately that valuation has to be agreed on by whoever the lead investors are for that round. For earlier stages, we're always very practical and reasonable, and sometimes we don't reach full agreement. So sometimes the valuations that are negotiated, they seem too low to us, but we're very practical. That these companies need money for success, so we're willing to accept the dilution, provided that that we've got the resources.
Yo, this is Christian D. Evans with Journey with Christian D. Evans podcast. Guys, thank you so much for tuning in and listening to our amazing podcast. This is where we reveal the top 1% of business concepts and systems and processes to scale 8 and 9 figure businesses. We interview top level 8 and 9 figure CEOs, business owners, and amazing TEDx speakers like David Meltzer. We got Nick Cavuto, Pascal Bachman, and so many others. And if you feel like this resonates with you, please share this with your friend, your family, and make sure you impact them as well, because we're trying to spread the message on those that do not know how to scale 8, 9 figure businesses and talking higher level business concepts. So guys, remember, enjoy the episode and be uncommon if you can. Cheers. Thank you so much for tuning into Journey with Christian D. Evans podcast. I'm your host, Christian D. Evans. This next guest that we have on is the CEO and founder of VIC Tech Technology Venture Development. Now, what is that? It is a VIC Tech. He develops the company's virtual enterprising business model to support the formation and development of cutting-edge technology startup companies based on potentially world-changing technologies exclusively licensed from top research institutions. Now, the way their conglomerate is developed is they have 4 pillars, 4 peers. VIC Foundry, which develops a pipeline of new technologies, the IP foundation. VIC Fellows, a talent pipeline for new companies so they can come alongside and help them grow out their talent source. VIC Investor Network, founding early stage capital into every VIC portfolio company. And then VIC Venture Fund, a follow-on capital rounds. So please welcome my next guest, the one and only, my friend, Calvin Goforth. How you doing today, Calvin?
I'm doing well. Thank you for having me on your podcast. Looks like you're locked up on my side.
Awesome. Well, thank you so much for being on our podcast. I'm very excited about diving into this. Yes. And I'm very excited about diving into this because it's really fun, because we were unpacking here kind of the evolution of this journey, okay? And I know that I was looking at your guys' website, which is incredible, vicnetwork.com. You have a huge portfolio of companies that you are currently working with in your portfolio. Now, I want to ask you first, kind of lay out that foundation. How did you come up with this methodology of finding these specific companies that you're looking to invest in, and really the whole ecosystem of VIC technology?
Well, it was an evolution, to get to where we are today. The original gist of the idea came from my own personal experience as a professor at a university who left a faculty position to start my own company. And I didn't try to start the company on the side. I just dove full in. And I stumbled my way to success in that, but I made lots of mistakes along the way, and frankly came very close to bankruptcy in that process. But I did eventually have success. Actually, not even really that long. 2 years in, I was able to sell that company and net a pretty good profit. But I also looked back on that and realized I'd left a whole lot of money on the table by not really knowing what I was doing. I just frankly, I got a little bit lucky, considering the number of mistakes I made. So my idea for VIC was to get a team of people comprising all the different disciplines needed to lay a proper foundation for new companies to grow. And so I brought in people that were complementary in background of myself. And originally we were a consulting company. And then we, started thinking, well, there's all these professors in universities that have these great inventions that don't want to do what I did. They don't want to leave their secure tenure track faculty position and put all their money and time into a very risky startup. But they do want to see their ideas come to commercial fruition. So the first iteration of the VIC model after the consulting was we would provide a business development team. We'd let the professors oversee the research, product development, and we'd start forming companies together. But that model didn't work very well either, because the professors really, had a research focus rather than a product development focus. So we were getting funding grants into the companies, and things were being done in the lab, but we weren't getting products emerging out the other side. So eventually we started asking the professor to serve in advisory roles and start bringing in product development focused people. And we added the VIC Investor Network so that we had initial capital the day we formed new companies. We systemized our assessment process, which is the process by which we screen technologies. There's literally thousands of technologies, available for license from universities, and there's, these are based on over $120 billion per year in federal research, over 35 billion of which is directly in our area, life science, and a larger portion of that, has applications within life science. So it's a huge pool of promising technologies. And we over time developed a very systematic process for screening those technologies. So I'll pause there. So I don't want to ramble on too long.
Yeah. No, this is perfect. I really appreciate this. And this pivots directly into another question, which screenlining, right? Filtering. What does that look like in regards to that technology? Because I would imagine, is that a lot of it has to do with intuition with the founder, or is it you're really diving deep into, okay, what's the market penetration possibility of this technology? Well, how much infrastructure do you guys need to establish? I want to know kind of what all goes into really unpacking. Hey, not only is this company good and valuable, but also that technology itself. What does that look like?
Well, keep in mind that we don't work with existing companies. Every company in our portfolio is a company that we founded. We have the inventors brought in as co-founders and technical advisors, but we've built all these companies from scratch. Our ecosystem is not to work with existing other people's companies and support them. Our ecosystem is to build companies from scratch in partnership with inventors and other investors. But it always starts with the technology assessment. That's the beginning point. So we have a team of people that we call our opportunity assessment team. It's a 16-person team. It includes our managing directors from our different locations. These are all experienced, done it before, life science executives, includes scientists and engineers, and every week, and MDs, and every week, we're bringing technologies into these meetings, these screening meetings, and deciding which ones are worth a deep dive. So our process, it starts as an initial screen, and most technologies get ruled out quickly in the initial screen for one reason or another. We've seen too many technologies like that. It's too much competition. The intellectual property landscape's too complex. Any of a variety of reasons. But if it makes it through initial screen into what we call our prospect stage, then we assign a due diligence lead. So if it's a therapeutic, we're going to assign a due diligence lead who has deep expertise in therapeutics. And they lead the due diligence, very rigorous process that looks at everything from the market opportunity to the capital required, to the regulatory path and timeline, to the intellectual property landscape. So a very systematic, rigorous process. We learned that it was well worth the money. It cost us a significant amount of money to do these assessments, but it's well worth the money we were spending on the assessment to keep from making a mistake in terms of which technology to base a new company around. From the prospect stage, it either gets, sometimes we see technologies that are really exciting, huge upside, groundbreaking technologies, but just so many unknowns and so many risks that we can't recommend to our co-investors in the VIC Investor Network or for our own money to form a new startup yet. So in that case, we'll move those technologies into the VIC Foundry, and we'll go after non-dilutive government grant funding. And we've been, very successful getting non-dilutive grant funding, both in VIC Foundry and across our companies, because the technologies are exciting. But then in the VIC Foundry, with the non-dilutive funding, if we're able to address some of those question marks, then the technology later can be moved, as the intellectual property foundation for a new company we form. But going back to the opportunity assessment process for a minute, after it goes from the prospect stage into what we call the active stage, then we write up a complete full report. Eventually, it includes our medical advisory board. We present to the appropriate members of our medical advisory board. We also have a strategic advisory board that we present to. The medical advisory board providing the deep clinical expertise, the strategic advisory board also providing the domain experience, in terms of commercializing these type of technologies. And from all that input, we assemble a presentation to which we present to the VIC board of directors, who make the final decision. Of course, I'm a member of the VIC board of directors, but I'm not the sole decision maker. By design, we want to make sure that we have broad review of everything. It helps us keep us from making as many mistakes. If the VIC board direct blesses it, then we license the technology in a new company we form. We bring in the inventors as co-founders and technical advisors. The VIC Investor Network, along with VIC Tech itself, puts the initial founding capital in. We install the initial executive team. Typically, one of our managing directors serves as interim CEO of the company to get it through those earliest stages of development. And then later, we recruit in the permanent CEO once the company's got some real traction. And that's basically how we move forward.
Now, this is very good. I really appreciate putting that foundation. Now, I'm curious, looping back around in regards to kind of what you're talking about. When you find that technology, right, you kind of explain what that looks like. It goes through a lot of filtering process, through a lot of boards that you have established, all the systems, which is really sweet. When you are talking to the inventor and you're acquiring this IP, is this a partnership? Is this kind of or is it the negotiation? I would imagine it probably depends upon what they're looking for as well as yourself. Because if you see the technology, you obviously want the founder that created this technology because they can drive, but they may or may not be, depending upon their skills, they may or may not be really good at sales or marketing or running a business, but they're really good at that, technical, software or technology, whatever it is. So just help me understand, contextually, when you come to that deal flow or that deal board or like negotiating table, if you will, obviously I know it's very contextual, but just help me understand, like, obviously you want to make a win-win situation, but I'd love for you to just talk a little bit about that.
Yeah, that's a great question. And really, a significant part of our model is how do we create these win-win structures. And, the intellectual property is, since almost all of our companies are based on technologies we've licensed out of universities. We have also licensed technologies out of federal labs, and we have technology from an individual member. But by and large, the large majority of our technologies are licensed out of universities. So the university owns the intellectual property, and we have to negotiate a license agreement with the university. However, we need the experience, of the inventor of the technology, typically a professor at the university, or maybe a professor and one of his or her grad students, because they've already spent substantial time. They understand it, even if they don't understand the commercialization process, they understand the technology better than we do, at the beginning. And so we always want them involved. And so when we have that discussion with the inventors of the technology, we say, look, in our model, your role is going to be technical advisor. You're not going to be leading the company. We actually tried that where we had the had the inventors, the professors, leading the product development. It didn't work well. The professors are too busy in their full-time faculty job. They're research focused. They haven't often, I mean, there are exceptions to the rule, of course, but most of the time they haven't really gone through a complete early stage commercialization process. So their role is better served as technical advisor. And we explain all that to them. And we also talk to them about all the risks and hurdles, how much money it's going to take, what's going to be required to raise that money, how long of a time is it going to take to get, through the regulatory, process. What about all the competing technologies? No matter how great this technology is, there's always other people working on related things. And all those risks and challenges that you have to navigate to be successful. Now, the upside's huge. It's hundreds of billions of dollars for some of these companies, but the risks are high and have to be carefully managed. And we explain all that to the professors and say, look, in our model, you're not going to have control of the company. You're not going to get as much equity as if you formed your own company with your grad student and licensed the technology from the university, but you're going to have a heck of a lot higher chance of success. And usually we're convincing, because in most cases in the technologies that we're interested in, people want to work with us. Some cases, no. Some professors, they want to run their own company, and that's fine. It's just we always have that discussion early on in the process, because we want to make sure that VIC's business model is aligned with the professor's interests before we spend all that time on the due diligence process. So we take an initial look at, see if it looks interesting to us. Then we have that discussion. If that all looks good, then we go into the full-scale due diligence, and with a common understanding of what's going to happen on the other end if the due diligence ends up as positive. Does that answer your question?
No, it does. And I really appreciate you explaining this and kind of the sequence of events, because that's what I discovered as well, running a business. And I've talked to numerous people, and you have to focus on the right thing at the right time in the right sequence. Otherwise, if you don't, then you mess this whole thing up. So now you explain kind of what that looks like in regards to due diligence, having that conversation, being proactive. Now I want to talk about when you deploy that capital, okay, say, hey, everything's good. The inventor is like, cool, that researcher, right? And you guys make that agreement. Now it's game time, right? Okay, we've raised some capital, we deploy that. Okay, as VIC Capital, as VIC, okay, and Calvin, yourself as a CEO, what's your focus point? That next phase, that first starting beginning, like what you guys are focused on? Are you guys focusing on, okay, building out more the foundation, like the team, the structure around it, or is it more of, hey, we gotta put this out in commercial, and we gotta sell and make some sales and a value prop and actually get a proof of concept? What's that first phase that you deploy that capital to create that initiative?
Sure. So when you're talking about licensing technologies out of universities, which is what we do, as intellectual property foundations for new companies, you're typically talking about very early stage technologies that still have a long path to become a real product. So when we're doing our due diligence, we're always thinking about what with that initial funding that we put in from VIC and the VIC Investor Network, which for a medical device is typically $250,000, and for therapeutics typically $500,000, which in the total capital needs that company's going to have is a very small portion of the total capital need. But what we were always thinking about in the opportunity assessment process is, what are we going to do with that initial capital to really establish that this technology is viable and exciting, such that the company will be in position to raise much larger rounds of capital with the VIC and VIC Investor Network participating, but with also bringing in outside investors in the follow-on capital rounds. And in every case, we've been successful doing that. We've never formed a company, used that initial capital from VIC and the VIC Investor Network, and not been successful raising substantial additional capital. That's in part because we do a good job with our due diligence, But we also, we're also, I think, very good at executing on those early stages of development. So, where you start depends on where the technology is. In some cases, you may have, if it's a medical device, you may have a fully, full prototype that works. It's not ready for commercial production, but you may have a, laboratory prototype that works. Or in some cases, you may just have a patent filed and some very preliminary data supporting the idea, but with all our due diligence, we've developed enough confidence that we know we can make that, that product work. So, what we're going to do with that original investment, depends on exactly where that technology is. One thing we offer our VIC Investor Network members. So we actually have two groups in the VIC Investor Network. We have what we call the Founders Group, and then we have standard members. The Founders Group members are the members who put in the founding capital into every new company. So along with VIC Tech. So VIC Tech takes 20% of it, and the 80% comes from our VIC Investor Network. And what we've done with the Founders Group is say, look, we're asking you to commit to investing in every new company VIC forms. And these are very high upside, but also risky companies. So in exchange for agreeing to invest in every new VIC company that forms for as long as you maintain your membership, you can pause your membership, and wait for your exits and then rejoin. But as long as you're maintaining your membership, in exchange for agreeing to invest in this blind pool and having trust in VIC to be able to execute, we're going to give you exceptionally attractive valuations. So for a $250,000 investment into a medical device company, founding investment, we're going to give you a $500,000 pre-money valuation. Doesn't matter if the company's, if we went out on the kind of open investor market, we could raise it at a much higher valuation. Doesn't matter. We're pre-committed. Every $250,000 founding investment is going to be going in at a $500,000 pre-money valuation, which for these type of companies is extremely attractive. And similarly for therapeutics, for the $500,000 investment into a therapeutics company, we're going to $750K pre-money. And sometimes these companies already have substantial funding line. We have a company, a therapeutics, actually it's a vaccine company that we formed about a year ago that already had $18 million in non-dilutive grant funding lined up. The day the company formed, doesn't matter. The VIC Investor Network money still went in at a $750K pre-money valuation because that was our commitment. So the upside for the VIC Investor Network members is really high. Standard members invest in the round after the founding round. So they get diversification. They can put some of their money in late stage companies that are approaching exit, some still in early stage at attractive valuations, but not as attractive as, as the Founders Group and money went in earlier. But anyway, that's our, that's how we do it. And when we're looking, how do we deploy that money? It's always, what can we do to de-risk this technology and position this company for substantial follow-on capital? And like I said, we've been very successful doing that.
And that's what I think is so incredible about your conglomerate. And I like to call it, your conglomerate because because you've done this for so many years, what the pain point definitely in this industry you've niched down. And what's so interesting is this has no proof of concept. This is not even retail at all, but you're going out there basically reaching out. It's an idea, or maybe they have a solidified, but that's why it's very contextual. And that's why I wanted to make sure our audience understands that. And I really appreciate unpacking that. Now I'm curious now, okay, so we're at this focus point and there's a lot that goes into, this technology. Like you mentioned, this IP, maybe it's patent, maybe it's just building that kind of the back end coding, product development, whatever it is, right? And I want to talk, because you mentioned this, mitigating your loss a little bit, right? There is a point where, okay, you know what? We put a lot of money, we put a lot of time, I got my team, and we're putting a lot of time and energy into that. Do you have, and I'm curious, is it just more of an intuition, or do you have a kind of a system and say, okay, you know what? We've gone this far. we got denied with the patent, we got denied with this, whatever, etc. And it's not it's not building into fruition like we anticipated, or some certain things fell through. Do you go down and say, you know what, staying on the consistent path because you see the longer game and you always play longer game? Or is it like, hey, you know what, we're going to go ahead and mitigate our loss, and we're going to pivot, and we're going to take our time, energy, and resources of our team and deploy it into this company that we're obviously seeing a better valuation? So I just want you to help me understand your perspective and when you're looking at it, because I know it's very contextual and you got to paint a picture in regards to each situation.
Yeah, another great question. So there's a lot of different scenarios. We had a company, for example, that we licensed the technology. It was from, actually, I forget which university this particular one came from, but we licensed the technology and we hit some technical hurdles that eventually we just saw as being insurmountable without just an incredibly large, cash investment. So we at that time had to choose, well, do we shut this company down or do we pivot? And so one of the things that's nice about our system is that we look at so many technologies, we see so many different things. So in this particular case, we said, well, this technology that we licensed as the foundation for the company isn't going to be successful. But here's a related technology, which based on everything we've learned over the past couple of years trying to get the first technology to work, this technology really should address those issues. And so we licensed a new technology out of a different university. In this case, I remember there was the second university, it was University of Colorado, into the company. And now that company is, positioned for huge success. So I'm certainly happy we didn't, shut it down. But also I'm a big believer in, you don't want to throw good money after bad. So if you eventually hit a point where, you're just continuing to invest time and money into something because you're just stubbornly wanting it to succeed, but in reality, it's no longer a good investment. It's not the reward isn't commensurate with the risk. Then it's better off just to shut it down. And in all cases, what we're doing is we're looking what are the possible pivot points if we hit a problem, but we're always gauging the reward to the risk. The reward for new capital going in, the reward for the also the existing shareholders. Are they going to put more capital in? All those kinds of things. But you don't want to throw good money after bad. Fortunately for us, our success rate's high, even though these are risky businesses, in part because we do a good job with the due diligence and execution, but also in part because we do have the ability to pivot by bringing in new technologies, and we've done that in multiple instances where we've taken what's learned, brought in closely related technologies, and pivoted in a closely related direction, taking advantage of everything that's been done already, but with a new foundational technology that's related.
Yeah, let's talk a little bit about your successes. And I want to ask, because I do know a lot of the companies, I'm going to just name a few, and I may butcher some of the names, Akiso Biomedical, Biologics MD, Blue and Green, and then also Solenic Medical. So you really focus on the medical field in regards to the technology that you kind of acquire in that IP. I want to ask, I'm more familiar with the SaaS industry, where kind of the multiples, the valuations, once they hit certain levels, and the KPIs that we're measuring to kind of use that as the baseline to identify what those multiples are. With this technology, because it's just slightly different realm. I want to ask, like, how do you guys put that valuation? What stage you guys start kind of looking at? Okay, this is going to be a 5-7 year plan. I know, again, it's contextual, so maybe you could give us another case study or maybe another situation where it's like, okay, this long, we're going to exit at some point, but it's going to be a 7-year game plan. I do know, like VC world, they always like to do 2 to 3 and then have a 10x unicorn, et cetera. But obviously yours is slightly different. So I just want to understand your methodology in regards to when you're acquiring and building out this foundation, this company underneath your portfolio companies. You're thinking exit at some point, and we're going to talk about your exit strategy here shortly. But I want to talk a little bit about kind of that evaluation, those multiples, and what you focus on during the growth to ensure you maximize those valuation multiples in the back end.
Sure. So other than the founding investment, which, as I mentioned earlier, we have preset valuations for. Other than that, all valuations are based on a negotiation with the investors, whoever's leading the next round, which we participate. But when you talking the larger rounds, it's typically an outside investor leading it, and we negotiate the valuation. We have a lot of experience, so we have good ideas what these companies are worth, and so we're not naive about what's a fair valuation. And certainly it also depends on what part of the country you're in. If you're a company in Silicon Valley, typically the valuations in those companies are much higher than they are in the heartland or most of the locations that we work in. And that's actually an advantage to our investors. You get in at better valuations. But ultimately it's a negotiation. You mentioned SaaS. We have one company. It's all our companies are intellectual property based, but we have a machine learning based software as a service company. It's based on technology licensed out of Johns Hopkins University. It has a partnering agreement with GE Health. But there's a trade. The name of the company is CardioWise. They're introducing the product on the GE platform at a large trade show in November, and it'll be on the GE platform. Help for sales worldwide through GE as a sales channel partner shortly thereafter. So for a company like that, which is already it's FDA approved, it's on the market, our expectation is for that round is high 8 figures for the valuation, but ultimately that valuation has to be agreed on by whoever the lead investors are for that round. For earlier stages, we're always very practical and reasonable, and sometimes we don't reach full agreement. So sometimes the valuations that are negotiated, they seem too low to us, but we're very practical. That these companies need money for success, so we're willing to accept the dilution. Provided that that we've got the resources needed to execute, because almost all of our companies, really all of our companies, are $100 million plus type of exit opportunities at the stage that we'll take them to. Some of them are $1 billion plus. You're at the exit at the stage that we'll take them to. And so there's a lot of, because we're part of the founding group of the company and our investors came in early, there's a lot of upside for those investors, even if they're getting diluted down by the share price is always climbing, their percent ownership is going down, but they're gaining a lot of value. When we start a company, going back to your other kind of question that you asked, when we're doing our assessment process, one of our guidelines is we've got to see how to exit the company within 8 years. So some of them will be faster than that, but 8 years is our time horizon, saying if we can't see how to get to an exit within no longer than 8 years, then it's probably a better foundry. If we're interested, it's probably a better foundry project to do de-risking before, and later form a company. So for the founders group investors, we tell them, you're going to have your investment spread across, they invest in relatively small increments, but we aggregate a bunch of co-investors together. And we tell them, you may have your first exit in 3 years. It may be, depending on how many investments you make, it may be significantly longer than that. But you need to be willing to think about your money as being held in place for at least 5 years or so. It may be earlier, but you should expect 5 years or so. For standard members who can put their money, some of their money, for example, they can put their money in the CardioWise round that I just mentioned, where CardioWise is, I would expect is within 2 years of exit. Then it's a lot shorter holding time. So what we say for standard members who aren't participating in that founding capital round is diversify. Put some of your money in early stage where you've got really high upside. Put some of your money in the later stage companies, which still have a great return opportunity, but are less risky and faster return, and put some kind of in the intermediate companies. So the standard members can kind of tailor their investment profile depending on whether they're more interested in earlier high upside or later stage, lower risk and fast return. Founders group members have to accept that they're going to be at the very earliest stage, and these companies, can take a long time to get to exit.
So it's definitely a long-term strategy. However, like you mentioned on the back end, the multiples and the valuations, could easily be 9-figure, $1 billion exits, which is really remarkable. However, they'll have the right expectation, the right mindset long-term, right? Now, I want to talk a little bit and loop back around and kind of unpack this a little bit further. So I know in the SaaS B2B enterprise valuation, the kind of master KPI that everything is kind of structured is the annual recurring revenue, right? That's kind of the baseline to be able to identify what the valuation is. Now, like you mentioned as well, it's really dependent upon obviously that negotiation, that conversation, et cetera. However, though, I wanted to ask a little bit, Calvin, in regards to your technology. So do you emphasize the technology as more valuable than the financials and the sales? Or is it both? I'm just trying to understand a little bit, because obviously the technology, because it's so innovative, it's because it's so cutting edge, people are willing to spend just for the technology itself. But I mean, if you're able to also have amazing clientele and service X, Y, Z, whatever. So I was just wondering exactly what's the emphasis behind the technology, the IP itself versus, the financials, and what that looks like.
Right. So when we first start, it's the technology. When we start with a new company, it's the technology. It's a long way from generating any revenue. So the valuation has to be based on the technology and the market opportunity that technology represents down the road. There's no way to value the company based on sales or net present value calculations or anything like that. It's just too far down the road. For in our exit model, for VIC's model, we're not taking these companies all the way through scale. Our model is to get to the point where they're of interest to a large strategic acquirer. So, for example, I mentioned that CardioWise is on the GE platform. We believe GE is a likely acquirer of CardioWise after they establish some initial sales traction with the product. But that's in almost all of our cases. We're looking at strategic acquisition as our exit, and you don't have to go, super deep into the growth phase of the company in order to reach that point. So most of our investment rounds are pre-revenue, and then once the company has a product in the market and starts building sales, which CardioWise has just started, for example, then we're looking at exiting the technology So investing in these type of companies is, is not typically done based on revenue at the stage of companies where we're still building them.
This is so interesting, and that makes way more sense. You're not hitting growth stage in this. You're focusing on that pre-seed. You're focusing, maybe it just might hit that a little bit, but then all of a sudden you're looking at exiting. Okay, and that makes perfect sense. I appreciate kind of unpacking that. And that's because I was just trying to figure out, like, my assumption was you were hitting growth stage, and then there was that valuation of multiple. And it's like, okay, how are you guys calculating that? But no, it's more of over here. And then obviously you're emphasizing the technology tremendously, because obviously, and then they get acquired because those people want that technology, et cetera, et cetera. And I understand that place. Okay, gotcha. Now I want to, another question I have for you before I let you go here. The way you structure it, I know you have a fund, and that makes perfect sense. Do some of these, is it more of like a syndication? Is it like kind of an SPV where, these individuals invest into one and then invest into that one company, et cetera? How do you guys structure that? Or is it, again, it's just dependent upon obviously the company itself?
So for the VIC Investor Network, we always put the investments into an SPV. So like for the founding investments, we form a SPV. VIC puts in 20% of the capital. Our other VIC Investor Network members put in the other 80%. And it's a single line item, on the company's cap table. That's good for everyone. You don't want to, because the investors can invest in as little as $5,000 increments. So they can spread their investments across multiple companies to get diversification. The upside of these companies and the average returns, average IRRs are very high, but any single investment's risky. So diversifying across a number of companies is a great strategy. So we allow investors to invest as little as $5,000, and then we aggregate the investment into an SPV. For later rounds, then when it's not just the VIC Investor Network investing, but we have outside investors. Then sometimes it depends who we're going to. If it's a VC fund investing multi-million dollars, then obviously they're going to be investing direct. If it's angel groups with members who also want relatively low investment per person, then we're going to ask them, if they can't meet the company stated minimum, which is typically going to be $50,000 minimum in the kind of next round after the founding round. If they can't meet that minimum, then they need to aggregate investors together so that in the aggregate they at least meet that minimum, because we don't want a messy cap table with a bunch of individual 5,000 to 10,000 investors in the cap table. That's going to make it harder to raise capital later. Later investors don't want to see a messy cap table with a whole lot of investors.
This is making perfect sense. Okay, I appreciate how you structure that a little bit, because I think a lot of investors in general, that's obviously getting into the weeds a little bit in regards to how you structure it, but it's good for them to understand, but also having the right expectation in regards to kind of what that timeline is. And it's also, again, emphasizing it's not hitting that growth stage. It may hit just a little bit, but then there's an exit. And then we'll talk about here. Now, Calvin, I really appreciate you being on. And for those listeners that want to be, maybe consume more of your content, learn a little bit about what you got going on, be part of the either the fund or the investor kind of network that you have established, how do they reach out to you and engage with what you got going on, Calvin?
So they can go to they can contact me, calvin.goforth at victech.com, or they can go to the victech.com website, or they can go to the VIC Investor Network website, which is vicnetwork.com. Both of those websites have additional information as well as contact us form. But anyone that has interest, they're welcome to reach out to me directly, calvin.goforth at victech.com.
Awesome. And guys, those links will be in the description below. So make sure you stop what you're doing. And if you want to learn more, if you understand this and you want to be on the cutting edge of this technology and kind of invest alongside Calvin, and maybe even you have a network or you have an ecosystem that you could add value, then definitely reach out to him. So those links are in the description. And I want to ask you real quick before I let you go fully, is there any last words of wisdom that you'd like to share with our audience?
Well, I personally think it's really exciting to invest in these type of companies that not only have the opportunity for a high return, but also have real impact. You know, these technologies, you know, making a difference in people's lives, saving lives. So to me, that's enjoyable. That's something that, you know, adds on top of the high return opportunity is the impact of these, you know, life-saving, you know, life-enhancing companies.
That's awesome. I'd love to dive into this real quick. Calvin, give me a serendipitous moment where, hey, you know what, because you've been able to invest in this company, you've been able to see the impact of, you know, getting this idea, this innovation to fruition, whether it got acquired, whether you actually saw it. I'd love for you to just talk a little bit about that, Calvin.
Sure. So I mean, there's let me I'm trying to figure out which one's a particularly easy one to understand. So you know, I know, for example, someone who had a knee implant, a knee replacement, and they developed a infection on that knee implant. And what happens on these implants sometimes is there gets this, it's really a bacterial coating. It's called a biofilm. And that biofilm is very difficult for antibiotics to penetrate. So in not a high percentage of knee replacement surgeries, but periodically, they actually can't treat the infection. They actually have to take, you know, after this person's already gone through all the trauma of replacing their knee, they have to take that implant out and they have to treat that person, and then they have to put another implant in. So it's just hugely traumatic and expensive, you know, thing when that happens. So our company, Selenic Medical, which has FDA breakthrough designation, which is a designation that FDA provides to companies that meet a big medical need that previously has been unmet. You know, Selenic Medical has that designation. They have a system by which where they put a device around the implant. So if it's a knee, they'd wrap this device around the knee, and they use an alternating magnetic field to induce electrical currents just on the surface of the implant. And that electrical current disrupts the biofilms, and it completely wipes out, with antibiotics can penetrate and completely wipe out the infection that was previously untreatable. So that's an example. And we've got, that company is moving along fast. But that's an example, just one of, I mean, I could give for just about any company in our portfolio, I could talk about, you know, why is it impactful? But that's one example. We've got life-saving, Neurexis Therapeutics, life-saving, you know, stroke technology, new vaccine technology, which has the promise of being able to develop new vaccines quickly without some of the risks of, you know, the mRNA vaccines. There's, you know, just case after case. So it's fun to work on those things that really have that kind of impact.
Well, see, and that's why I can hear your passion, and I appreciate you we stopping here for a second and just sharing that, because I think that's so important, because this is to me, it's like the silver lining, right? You ever ask yourself, Calvin, you know, it's like, oh, what if we didn't find this person and this inventor and help him, come alongside him with your ecosystem and VIC technology, and help him actually get it to fruition. So now it can make an impact in people's lives. And you're doing that directly and indirectly all the time through all your companies and your portfolio. So I think it's so cool, because yes, you can make a lot of money. Yes, you can build multiples and valuations and all that fun stuff. And yes, you probably have a lot of stories of pain and frustration of some companies not developing fruition. However, though, when it is, and when they do, you start seeing like, wow, the impact and the influence you're making. So Calvin, I really appreciate you being on, man. Really do.
Well, I appreciate you having me. It's been a real pleasure talking to you today.
That is my friend, the CEO and founder of VIC Technology Ventures Development, Calvin Goforth. Guys, that a Journey with Christian D. Evans podcast. Until next time, be uncommon if you can. Yo, this is Christian D. Evans, Journey with Christian D. Evans podcast. We thank you so much for listening to this amazing episode. If you feel and you know that this was valuable to you, please show some love to our amazing guest by liking this, by commenting on this, by making sure that you do a nice 5-star review and just show some love to our guest. That'd be really awesome. Also, make sure you share this with a friend, a family, a colleague, someone that you believe would bring value to their life right now. And guys, we just want to say thank you again for just being part of our community. If you want to have more resources, don't be afraid. Go to christiandevans.com. You can actually schedule a phone call with me, or you can send me an email at christian.evans@beUncommonIfYouCan.com. That's christian.evans@beUncommonIfYouCan.com. Always love to hear some feedback and let me know what is the number 1 or 2 things that you are struggling in your business and your life, and we'll make sure we have those conversations. Guys, that is Journey with Christian D. Evans podcast, and until next time, remember, be uncommon if you can. Cheers.